With over $76 million in assets under management with his hedge fund DHF Capital.
There's people who are saying the market is always against us. On the other side, also people are thinking if I'm large enough, I'm gonna move the market. 100 lots, 200 lots, 300 lots, you still don't move the market. A lot of people are still thinking that retail has anything to say in this, and you don't. You're not trading real market volume.
Hedge fund manager, author, trader. Today we are joined by Bas Kooijman. In this episode, we explore the difference between retail trading and hedge fund trading when it comes to the Forex markets, the liquidity, how you place orders, and the exact strategies Bas uses within his own hedge fund.
For me, if I'm trading, it's almost like I'm sleeping. Just in the zone, my stress drops.
What changed in those 10 years for you to be able to have stats on your heart rate as if you're sleeping whilst maybe you're going through a losing trade?
I think the difference is that I think you have a large mental game when you're managing other people's money. I think it's very much compared to prop trading, where you also have certain rules and you have to adhere to them. Only the thing there is you make your own rules together with your clients, where the prop firm, of course, dictates those rules.
There are certain narratives within the retail space amongst larger influencers and big schools of thought that the market is algorithmically delivered and is kind of going against the retail trader, going to seek liquidity. How do you view that as a hedge fund manager?
I think...
Hello, ladies and gentlemen. Welcome back to another episode. I'm joined by a very special guest, Bas Kooijman. So usually we have a lot of retail traders on and we have platform owners. We've had a wide variety of guests, but we haven't had so many hedge fund managers. So I think it's pretty unique. You're a hedge fund manager here in Dubai. From what I remember, you initially started your journey in tech, and that kind of helps with the coding side of your firm at the moment. But you've had your firm now for 10 years. This year was your 10th year. And I want to take a deep dive into how you have, I want to say at a young age, being a hedge fund manager, managing other people's money, and also navigating through tech, through manual trading, through algorithmic trading, everything involved. I think it's a peek behind the curtains for a lot of us retail traders. So, my man, thank you for joining me.
Yeah, thank you so much for having me. Looking forward to deep dive into this side of trading.
Exactly. So I want to actually start right in the deep end and kind of understand, when it comes to retail traders, we trade a lot of retail concepts and it's very technical analysis, price action based. Enlighten me on what goes on behind the scenes at a hedge fund when it comes to a team you have of traders and a portfolio of funds. How do you divide the funds, and then how do you decide each pot how it's traded? Because you are doing commodities, gold, Forex, everything that we are used to, but maybe in a different way.
Yeah, so actually in our case, not that much in a different way, because we're looking for talent who does not want to work at the bank or the bigger financial institutions. We are more of a boutique fund, I must say. We are trading with about 25 people. So we are not really using like all the major, like I have Bloomberg to do analysis, but it's not that we are actively using anything more fancy than that you can use as a retail trader.
Okay.
I think our tech department is just a lot more sophisticated than what people can do at home. You know, we have our own data centers, we have our own algorithmics, we have our own risk management software. So a lot more things go into managing other people's money versus, I have a PAM account and I copy trade for friends and family. I think that's the major difference.
When it comes to the funds you have, obviously it is of high net worth individuals and you have certain parameters to adhere to, regulatory, I mean.
Yes.
Does that add a feeling of restrictions that maybe when you were initially just family and friends and your own funds to now working within the parameters of legalities? Do you see it as a way of it protects the clients, or is it actually a beneficial thing?
Yeah, I definitely think that regulatory support, I must say, in a positive sense, protects the clients. It doesn't really change a lot if you give yourself the space. So the only real restriction we have from a trading perspective is stick to your prospectus. So if you're saying I'm doing 50% FX, I'm doing 10% gold, I'm doing X amount of Euro stocks and X amount of US stocks, you just can't change that. Then you need 51% of your shareholders in the fund to say like, you want to trade oil? Great, I will give you my okay consent to trade oil. But till it's in the prospectus, not allowed to trade outside of what you just discussed with them in a formal way.
The reason I asked that question is more because it's very common for a retail trader to see a hedge fund or institution or a bank as like whatever they do is perfect, and therefore I need to emulate everything they're doing. Obviously, overlooking the fact that hedge funds and banks can also have a losing year. They are not perfect, but it's also just because they are the guys in the suits and the professional background that we assume everything they are doing we should look to mirror. But then they have other scenarios, for example, regulation that I as an individual don't have to deal with. Can you explore kind of the major differences a retail trader has versus a hedge fund like yourself on actually taking trades and the environment that you're in?
Yeah, so another very big difference is, of course, the risk that you are taking with your own money. You have that full option to go all in on red if you would like to, which with professional money you probably don't want to or shouldn't do. I think you have a large mental game when you're managing other people's money, because you have maybe discussed a certain amount of drawdown, or in your prospectus is stated a certain amount of drawdown, and there you have limitations. I think it's very much compared to prop trading, where you also have certain rules and you have to adhere to them. And I think with hedge fund managing trading, it's kind of the same. So you just, only the thing there is you make your own rules together with your clients, where the prop firm, of course, dictates those rules.
What does it look like with regards to leverage? For example, let's say I have $1 million account, but I get 1 to 100 leverage. I have access to the buying power of $100 million. Whereas in a hedge fund, do you have access to the same level of leverage?
In Europe, we have a little bit less leverage. So we are regulated in Luxembourg. We work together with the CSSF there. And in Europe, it's limited to 1 to 30.
But still good enough.
Technically, that's still possible. The question is, how much risk are you able to take, and what is mainly that drawdown percentage for towards client funds? So you mostly don't use all of that leverage when you're trading into larger funds.
You mentioned the risk department, as opposed to a retail trader that's maybe very 1% risk per trade. Maybe if it's a bit of a losing period, I want to be a bit more calm on my emotions, 0.5% risk per trade. Maybe if I'm really seeing an A+ setup, 2% risk per trade. That's kind of the breadth of an individual retail trader. What does it look like in your side?
So in our case, we are looking for kind of retail talent to keep doing what they're doing. So this is, in our case, very similar.
Oh, how interesting.
On the other side, every trader in our case has his own account. So every trader has his own account. It's almost like a funded account, where they are sticking to the rules based on what they are allowed to trade and what kind of risk they are allowed to take. Then every trader's account is being copied forward towards their department account, which can be a sub-asset class or asset class like FX or gold, and separation, which includes a little bit more security. So if an FX trader happens to hit that gold button or happens to try to open an oil trade, it simply doesn't go to clients' money. So there's a security level there. And everywhere are limitations. So for example, we have 1% a day, or 3% a week, or 10% total drawdown from your last high. That are rules that are put on the trader's account of, for example, 100K or 200K. Depends a bit on what kind of leverage he needs.
So let's say the fund has $10 million and you have these 20 traders. How do you divide the pot? Because obviously you've mentioned in your prospectus you have asset distribution. So is each trader trading every asset, or this trader is a gold specialist, this one is a this specialist, and therefore you distribute the pot accordingly?
Yeah, mostly you see specialisms in this kind of markets, because you have people who are trading technical analysis on FX, so they can trade all 21 pairs based of the majors. But gold is mostly separate, and equity desks are also separate. Yeah.
And more performance related, do you just give everyone the same amount, or do you kind of cycle capital between, okay, he's on a hot streak, he's on a bad streak, and move it around? I'm more trying to understand the individual side. I can kind of understand and we can explore it, but more from your position as the manager, how are you dealing with risk, capital, and also adherence to the plan on the prospectus?
Yeah, so our goal is that every trader has their own account and takes a lot of that mental stress away. Because if you have an account with 200 million that you have to trade, you have to adjust your lot sizes, you have to adjust your risk, you have to do a lot of calculations. So in general, all traders, they have anywhere between 100K and $1 million account that resets maybe every day or every week. So basically the account stays the same. You get used to your lot sizing. You get used to the amount of profit or loss that you're trying to make or avoid. After that, we do the forward copying towards the sub-asset class or towards the major pool of client funds.
So as a trader in the firm, I might see $100,000 on my account, but you could pair off those trades to maybe $1 million on the back end.
Definitely.
And is that simply to shelter the psychology of the individual trader?
It's mostly actually a best practice that we figured out in the last 10 years to get that psychology part out of there. So traders, only till they get their bonus, they don't know how much they were trading.
Oh, that's cool. And when it comes to a lot of the psychological problems that I'm sure you're aware of or each trader is aware of, on this show, we've discussed at length with various guests on how to deal with fear, greed, fear of missing out, and the normal stages that a trader can encounter. I see you have your Whoop band. Sorry, yes, you have your Whoop band, and you did a podcast with them, kind of exploring the emotional side of trading and how you can reflect it on your band and see the stress and so forth. I'm intrigued to hear from a hedge fund manager's perspective how emotions are dealt with and what those emotions look like on your Whoop band.
Yeah, so the nice part from Whoop for me is basically the moment you can measure stress, right? So it's heart rate variability, and therefore they can measure stress graphically. For me, if I'm trading, it's almost like I'm sleeping. I'm just in the zone, my stress drops, and
win or loss.
It's like nothing, doesn't matter. Nothing happens on my heart rate. Where, for example, I have a stressful meeting or I just have to go on CNBC interview 5 minutes before, I do see the spikes and I do see the stress and I see the things where I'm uncomfortable, right? So I think stress on your body is when you are uncomfortable or when it's positive stress like sports.
So if you were to be wearing this Whoop band, let's say 10 years ago when you were earlier in your career, do you think you would have had that same level of calmness?
No.
Or, okay, it was another case. So what changed in those 10 years for you to be able to have stats on your heart rate as if you're sleeping whilst maybe you're going through a losing trade?
Yeah, so I think the difference is that you are, as you said, you have a certain risk parameter. You just need to have that edge. And if you know that you have an edge and you have a winning rate that is technically more than 51%, you just have to keep trading. It becomes more of a profession where you just say, I'm going to the bank and I'm trading 9 to 6. And I have the amount of trades that I can do today. There might be a limitation on how many trades I can do, or an asset manager gives you a call and say like, hey, you have a bad day at 11 o'clock, maybe you just want to go home. We have a lot of traders who don't trade 5 days a week. If they have a great week, maybe on Thursday they go home. If they have a very bad week, they may be on Wednesday already home. So it's...
And how do you manage that emotional side? Do you let them have free reign and say if they want to take a day off? Or are you kind of advising, say, hey, look, it looks like you're having a tough week, take the rest of the week off?
Yeah, so the goal is always to start on Monday. We very actively are in touch with all our traders. It's a small group of people. We do a Monday call, outlook of the week, economics, economic calendars, everything. And then basically it's just get started. We have the daily limits of, for example, 1%. So when you hit that target, you go home for the day.
Okay.
Then the weekly target is 3 days your target. 3-day target is your week target. So if you hit that target on a positive side, you go home. On the negative side, you go home too.
Okay. So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
And if you then close out your week negative, you basically finished up till, okay, take a long weekend, take a break, see you on Monday again. And also that is very emotionless. Mm-hmm. It's just no problem, it happens to every person.
So when a trader is being told these kind of parameters, and I've heard other traders speak about this on the show, of 3 wins and you're out, 3 losses and you're out, and you just kind of walk away from it. the reality is it's easier said than done.
Yes.
And I think in your scenario, you can enforce it. You can shut them off. You can shut off the capital.
Yeah.
But on an individual perspective, the thoughts that an individual may have to not walk away, even though they know they should, is what if tomorrow there's a great trade and I miss out and I could recuperate my losses of the week so far? And that obviously can lead them into a tilt, but maybe once or twice they do recuperate and that becomes a confirmational bias.
Mm-hmm.
How do you as a hedge fund look to see that not every day in the market is a trading opportunity and some days are better than others, and maybe the bad day you traded it and took losses, and then maybe the following day when there was a good trade that you would have taken that would have recuperated the losses, the system said you're shut off. How do you look at that from the macro?
Yeah, so basically with let's say 3% a week drawdown limit, you should be able to trade all 5 days, right? Because maybe Monday is bad, Tuesday is good again, so you still have like funds, let's say, to keep trading the whole week. So in generally, everybody is every morning in the office and just sees how it goes for that day. And that's, I think, the main goal. And you don't overtrade. You use the same lot sizes. You have the same risk parameters. So I think that this kind of this level of trading, let's say hedge fund management trading, is just a lot slower than retail. Mm-hmm. Like we don't make 20% a month or 10% in a day. Like we don't have those days.
And is that because I'm not sure if it's from a place of you can't. I'm pretty sure you guys as a team definitely can. Is it more because the investors would feel uncertain or maybe like confused because they're used to 5, 7, 12% a year? So if you start to do 20, 30% a year, they must be like, something's up here. Yeah. Maybe you guys are not doing good things, and it brings skepticism and therefore less capital. Is that a correct line of thinking?
Yeah, it's kind of the right way. We have therefore different funds also. So we have a mixed asset strategy, that's the alpha fund. We have a little bit more leverage, is the gamma fund, for people who want to have a little bit more excitement, let's say. Mm-hmm. And we have an FX only fund, which is of course way more volatile. And people see historical returns, and the FX fund definitely goes towards 24 to 30% a year. Okay. I know in retail you can make that in a month or in 2 months, maybe a bit safer. Mm-hmm. But in our case, people are comparing hedge funds with real estate investments or stock investments or S&P 500 comparisons. It has nothing to do with us to compare a S&P 500 with an FX fund. But they just have that kind of mindset. And they said, okay, if I make 8% a year, 10% a year, that is kind of a goal. So everything above, we do a good job. But yeah, if you would make 100% in a year, they're saying like, how risky is it to do so?
Yes. Do you think net exposure is something that is an important consideration? For example, let's say a retail trader that is doing 5 to 10% per month through prop firms and consistently getting payouts, and maybe you look across the whole year and they did 50 to 100%. Yeah. But then somebody would question them and say, well, how are you beating every hedge fund that there is? Is it a case of, well, if they're doing 1 to 2% risk per trade, their total exposure for the year was maybe the whole 100% of the account, if you accumulate it?
No, not at the same time.
Of course not at the same time, but more to say like this whole 1% per trade idea, is that something that makes sense from a hedge fund perspective?
Definitely, yeah.
Oh, okay.
And we need those traders too. So our result is at the end the average result of the group. Mm-hmm. So we do need the higher winners as well, as you also have people who are losing. So at the end, it's kind of teamwork on an individual account. I
understood that the reason a hedge fund is going for the 10, 20% mark is because they're not doing 1% risk per trade. They're doing maybe decimal risk. So if they were to standardize 1% risk, maybe they do get these 100% gain at the end of the year, but it's just scaled down. So as a percentage gain, it's less, but as a risk to reward perspective, maybe it's equivalent.
Correct, yeah.
Okay. When it comes to the distribution of funds, why is it that certain investors are okay with FX, certain investors kind of lean away from FX? What is it about FX that is controversial,
it's mostly very personal, you know. Have they tried to trade FX themselves and blew up a personal account? Did they hear that from a friend or a family member who tried to do FX and it was not successful? So I think in generally it's a very personal feeling about FX markets. Our FX fund is only being bought by investors who are having their own equity desks. They have their own real real estate, they are mixing it themselves. Otherwise, we advise more to go into multi-strategy, where you have that mix of, okay, FX is having a good month, maybe equity is a little bit less, and we had an easy year on gold even.
So would you say part of your role is just managing clients' expectations, advising them, overcoming their misconceptions that they may have? How much of your time is involved in that?
I'm mostly coming in more when it's becoming a bit more detailed about the strategy, but definitely our relationship management team, they all have to like kind of rebuttal those fears in FX trading only. But when it's a mixed strategy, it's very understandable that you're trading FX as part of any hedge fund.
And within your firm, what is your average clients? Who are these people that are investing? What is the usual amount that an individual would invest? And usually, what have you found is their risk appetite?
Yeah, so we're only allowed by regulation purposes also to trade for professional investors. In Luxembourg, that means $150,000 and up. So that level is actually still quite low compared to other jurisdictions. Therefore, we also chose Luxembourg to help kind of as many people as possible with a strategy that performs a lot better than real estate and your savings account in the bank. And it starts from there. It starts from entrepreneurs who have made their funds with their personal businesses. It can be family funds, family offices, small corporates that have just a profitable year, and they're like, hey, what am I going to do with this savings account on a corporate level? So it kind of goes from high net worth individuals all the way up to institutional investors.
And what is their usual risk appetite? For example, let's say a prop firm, they will let you go into 10% drawdown before you lose the account. Therefore, that's kind of the assumed standard in a retail perspective. What does it look like in a hedge fund?
So our alpha fund is 10% and our gamma fund with leverage is 20% maximum risk that we are inflicting on every trader. So it means that actually within the fund it's way less because not all traders on all different asset classes will be able to hit that risk on the same day, week or month. So the actual net risk, we may have maximum hit a 4% drawdown at any point in time.
I see. Historically speaking, within your firm, what is the most safe or maybe most lucrative, profitable asset class that has been traded?
It looks a little bit like the year. So this year, of course, the gold markets have been doing phenomenally well, especially if you trade them, not only buy and hold, but even if you buy and hold, the gold has just made an insane bull run. Of course, equity markets were easy over summer. FX is actually struggling this year, low volatility or unexpected volatility, which is really bad for any automated strategies. So we are actively speaking, of course, with our peer groups, brokers, liquidity providers, and everybody's kind of happy when this year is over and looking positively to next
Trump
year
reign.
again. Yes.
And within the portfolio of funds that you have, how do you divide the pots between, let's say, the algorithmic side and more small short-term trades versus just buy and hold, like a gold buy and hold? How do you divide the pots between duration of trade duration, let's say?
Yeah. So in the FX desk, we have quite a large pot of the total fund, but it's split in three pieces. So we have 20% short term, which is actually average 6 minutes duration, which is just fully automated. And then we have 40% in kind of swing trading and 40% into position sizing orders. So those trades can take months. We'll be just in blue and just wait for a certain pair to continue.
So the swing trading, I'm assuming, is days to weeks. Is that how you would be defining it?
It's a couple of days. Try to close on Friday, close your book. If not, try to close them next Friday. So let's say up to 2 weeks open.
Okay. And I'm very intrigued to hear about the algorithmic side and average trade duration of 6 minutes. What can you find to give you certainty in a trade? It's a reaction at that point. If it's a 6 minute trade, it's just a few points or a few pips. What exactly are you looking for? All the algorithms looking for? What are their parameters to get in on certain trades?
Yeah, so it's mostly the very high liquid FX pairs, so like euro dollar, highly liquid at many moments during the day. An algorithm like that would do like about 1,000 trades or 1,500 up to 1,500 trades a month, 24/7.
Wow.
We have a 24/5 team here in Dubai. So the IT desk is open from Sunday night all the way till Friday night, and then Saturday maintenance. So we literally have shifts, people always, the light's always on. And we keep an eye on that algorithm to mostly still try to take the trends and then very short trades within that trend.
What is the team doing when it comes to monitoring or checking on the algorithm? Is it still manual execution once it gives an idea, or is it just monitoring the parameters?
On the short term, it's like fully automated. So we are just looking for high volatility, unexpected volatility. We are able to turn off certain automation. Let's say just the day before the election, we just choose to go risk off, as we call it. So basically everything goes off. We just wait it out. After market stabilizes a bit, you turn it back on.
And because you do have a tech background, what was the process of building your own algorithmic trading models?
Yeah, it's very interesting. It starts with an idea, manual trading, and also listening to a lot of other traders. My goal is always that I can kind of automate every trader strategy if you can tell me your rules. So if you are able to exactly say what's your entry moment, at least I can automate the entry. So even for our swing trading team, we are able to automate entries. We just believe that the exit is way better done by a person than it's done by an algorithm.
Why is it like that?
The algorithm is basically always lagging in their exits. So, and also the human factor, you know maybe what's going on in the market, or you're seeing something in the chart based on experience that an algorithm doesn't see. AI is changing the game by actually being able to, let's say, look at charts and making way different choices, and probably exit strategies are going to be better and improving over time.
When it comes to building an algorithm, certain things I can understand are very codable. Let's say a supply zone. You can give it parameters of, did it lead to a break of structure or a new lower low? Look for the candle, let's say that was the origination point, and draw a box out. That's your supply zone. That is very binary. You can kind of put exact code in for that. But when it's something like perception of momentum. Let's say you can see the momentum in the market of, I'm seeing prices coming to my supply zone, giving a rejection. That rejection, it could be across 3 candles, or it could be across 12 candles. And obviously as an individual, you kind of see the pace and you see, these are large bearish candles. These are very slow, choppy price action. But it is a bit subjective. It's not like the cutoff point is 7 candles. So how do you algorithmically build in that kind of sixth sense of a trader?
Yeah, so some strategies are very difficult because you would not define within 3 candles I'm doing X. So that can be more difficult. Mostly it works with percentages. So it's like, we are seeing a certain spike of a certain amount of pips. If it's more than this amount of pips, it's qualifying as a spike. Then we are expecting a 50%, 30% pullback, for example. So we're trying to trade that pullback. So it's like, if you can make it into rules, if you can connect it to a certain time, like market opening, if the market opens and then within X amount of times the time frame, I want to see a certain pattern, and then I go long for the day or get short for the day. So this is, and it starts to be more and more sophisticated. Like on TradingView, you can have a head and shoulders pattern recognition. It is not a perfect head and shoulders. That would be algorithmic. The recognition part starts to be a little bit more AI and smarter systems to be saying like, this looks like a head and shoulders, so we are going to do something with that.
When it comes to 6-minute trades, I kind of want to get into that. So very typical technical analysis would be, let's say, market structure, supply zones, trend, Fibonacci and trend lines, these kind of things. But usually these are, depending on the time frame, going for a whole trade impulse. You're looking for a new lower low in a bearish market, and that could be on an M15 time frame. That could be the rest of the day. On a 1 hour time frame, 4 hour time frame, could be the rest of the week. Yeah. What exactly are you looking for to get a trade for minutes?
Yeah, so this is actually more of in our swing strategy, something that you trade for the day or intraday. But the short-term strategies are basically just like, oh, we are expecting this market to go up for the rest of the day, but we are only going to get in for 6 pips, and then you get out. And then every time there's a little pullback, or anytime there's a tick up in volume, or the volume slows down, you get in, volume increases, probably in the direction of that trend, for example. So it's unlimited in the amount of indicators that you can program, but we have seen the more you put, the more difficult it is to actually get into orders. So if you want to get to the high amount of volume of trades, which actually is good for a short-term algorithm because you have simply more chances, you just test it, and it needs to be 51% plus. And if it does that, then it's basically ready to run. Another thing we do is a little bit of a look in our kitchen, but another thing we do is that we say to this certain bot, only buy, and another bot, only sell on the same pair. So basically you're mostly hedged, which means that the market goes up, you're starting to take all the profits. The other one goes into slightly drawdown, but manageable. And then every time the market turns around, the other one starts to win. So basically you have no market exposure because you're constantly in hedged. Some form of a hedge, but you are taking all the profits, and then it goes the opposite direction. You make all the profits on the other side. For this, you need large accounts. This is not possible on a 100K account because at the end that would go wrong.
Large account because of margin reasons, or?
No, because you need the amount of buy orders and the market to turn. So if the market goes too long into one certain direction, you are hedged, which is good. But we still have the weekend. We still have the higher spread on Sunday night. So there are certain limitations where you need good balances for this kind of strategies.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come. How interesting. When it comes to uptake in volume, you mentioned specifically in Forex, how are you defining volume? Because from my understanding, at least from a retail perspective, we can't really see true volume in the market as you would in maybe the stock market. How are you kind of making leading indicators based on momentum of candles, or are you combining a basket of brokerages and kind of getting their order book?
So this is the part where the hedge fund business probably has just a little bit more technical advances. We have our own bridge. We connect with 1,500 brokers.
Retail brokers, ordinary retail brokers.
Different. It can be brokers, can be liquidity parties. It can be basically the parties that are behind the brokers. And you can see all the depths. You can see all the volumes. You can look into 5 to 10 times the depth. There's the top of the book, and then you have different layers. So you can see way more actual volume being traded. The only thing which you cannot see is what brokers choose to be book, because that volume is internalized. So you see the volume that actually goes to the market, which means if all the dealing desks do the right job, you can almost see that as an indicator where the market is going, because that's where all the A-book goes.
So within that pool of orders that you see, as you've rightly said, majority of retail orders are most likely internalized risk, therefore B-book. So therefore the orders that are making it to the markets are more likely to be institutional orders. Am I correct in saying that?
Yeah, or the broker has a very good dealing desk to choose what to A-book because they don't want to lose. And then another option is we have the whole future market and all the future pricing on Bloomberg. And there we see all the volumes between the larger banks. So I can see all the volumes between Deutsche Bank, JP Morgan, everything. flowing around. So we filter only orders over 10 million, and then you can exactly see which side they are buying or selling.
So I had on the show Robin's World Cup winner, which is Patrick Neal. He was, within his strategy, he was utilizing futures volume but trading FX.
Yeah.
I wondered why he was doing that. He mentioned because the conditions within the Robin's Cup was more favorable for FX regards to commission spread, but he was still utilizing futures volume to make decisions in FX. Is that something it seems like you're also doing?
Yeah, it's very interesting to get volume information. And another thing is you can basically see futures if you're trading more longer term. So if you're trading more longer term, there's already orders going into the books for euro dollar half a year from now. Banks buying each other's futures. So if you see, there's 100 million going for a half a year future of euro dollar, for what price did that order go? So we don't have a glass ball, but because they can all be wrong, which means that they are going to lose on that order. But you do see almost where the whole financial market thinks that the order is going to go, because that's priced in the future.
So coming back to not the futures volume that you see, but the order book through the LPs and so forth, how real time is that? Is that basically an instant insight? Yeah. And what is the access that you have, or is there a way an individual could access it if they have a large enough account, or if they're willing to pay certain fees, or is it just not possible as a retail trader?
It's infrastructure, so it's very difficult. It's like an IT team building the bridges with the right software, making connections with all those liquidity providers that all have minimum
so it's internally
volumes.
Created. It's not like I can plug into something. No. And I see.
Yeah.
And how powerful has that been once that whole infrastructure was built within your trading decision making?
It helps for the longer term trading to be able to get this kind of information. At the end, information is key. And I think mostly Bloomberg data, which is something I don't advise any FX trader or retail trader to look into. A Bloomberg terminal, I think 1,500, 2,000 euro a month just for the subscription to see what potential futures it holds, unless you're position trading and you really look into the long-term data of FX.
Okay. And when it comes to actually seeing the live order book through the bridges and every infrastructure that you have, what are you exactly looking at? So if you can see everybody's orders and how they're positioning in, can you also decipher between the order types of somebody that is selling because they see a bearish outcome versus someone that is taking profits and therefore becoming a seller? Can you kind of decipher decision making of aggressive, weak intentions, spoofing, all of these things?
Yeah,
or is it just orders?
No, that's very hard. So you can't see all the orders. You basically just see the depth of the of what is top of the book, where the brokers are having liquidity to execute trade, or how deep the books are going. So I think that's where if you trade larger lot sizes, I'm talking 100 lots, 200 lots or more, starts to become very very important that you can calculate what slippage you are going to get, because you know in what kind of layer you're trading.
Yes. So is it involved in your decision making of the analysis, or more understanding what kind of a position size I can take?
Yeah, so it's mostly sizing, especially when it goes to the full client accounts.
Okay.
What kind of sizes are we dealing with, and how is that going to affect? And if you're talking about 6 pip trades, but you get 7 pip slippage, you have a problem.
Yes. When it comes to, let's say, the typical supply zone on M15, which might be 20-30 points on EU, you can see at times price reacts on the open of the supply, just taps and goes. Other times it consolidates in there and then maybe does a spike up to the extreme of that supply and then goes, meaning to say there is many points within the supply zone price can react, but all we see is a candle. I always assumed that one is the percentages side of, like, it's a standard deviations, normal distribution. It's just probabilities. Sometimes it's 100% retracement. Sometimes it's just tap and go.
Yeah.
But is there something deeper within there? And I always assumed it would be volume based, that there is a certain bunch of orders that the market is seeking out. Once those big orders are fulfilled, then the market is ready to turn. And if you are able to see that, then you can kind of foresee, okay, price is not going to tap on the open today. Maybe it doesn't make sense for me to enter yet. Does volume tie into the reaction points within a supply zone?
I don't know if it's the volume. I think this is also more not even seen by us, but more seen by the brokerage firms itself, where they are, of course, being able to see see people take profits and stop losses, etc.
Okay.
Where there's active dealing desks, almost all automated at this point. Like if we're talking 5 to 10 years ago, the actual deal making was still manual. And I think way more activity on the charts would be different per broker. So you would see a certain chart in a broker A and a completely different looking, not completely, but a different looking chart or different looking spikes on other brokers. A lot of manual dealing. At this moment, it's almost all automated, and therefore, it takes the whole market.
There are certain narratives within the retail space amongst larger influencers and big schools of thought that one side you can look at the market as it's a resultant of everybody's actions and decisions, and therefore the market is an accumulation of everyone's behaviors, whereas other people will see it more as nefarious approach, which is the market is algorithmically delivered and is kind of going against the retail trader, going to seek liquidity and more algorithmic matrix, that kind of topic. How do you view that as a hedge fund manager on the side of the market is algorithmically coded and out to get our liquidity?
I think the truth might be somewhere in the middle. But what I would say is that there's people who are saying the market is always against us, and it's a good excuse if you're losing to find someone else's mistakes. On the other side, also people are thinking if I'm large enough, I'm gonna move the market. Like if you do an order 100 lots, 200 lots, 300 lots, you still don't move the market. So a lot of people are still thinking that retail has anything to say in this, and you don't. A lot of the orders, almost 90%, maybe even 95% of retail orders are internalized. They never hit the market.
Yes.
So basically within that broker, it's all just charting. You're not trading real market volume.
You mentioned algorithmically delivered, or you kind of saying that there is 100% algorithmic movement of people's orders. What does that truly mean?
So basically, when you are starting to trade from hedge fund perspective, you probably deliver your orders straight to the market. So it goes actually to LPs like Deutsche Bank, JP Morgan. They can even choose to internalize them again within their bank.
Okay.
But in generally, it goes towards the book, and you're actually like someone buys, someone sells. But I always say like everybody can make money. I can be a short-term trader going short from buying that short from a person who is finished with their long.
Yes.
And then when they start to be their long position, they can make money good. And then a little bit later, we are buying their short position again for a pullback on a shorter time frame. So it can be that literally multiple people in a row, if you talk about same lot size, theoretical example, all make money in a row. We can also all lose money in a row. So it's not this one person against the other person. It's more like the volumes are so big. We're talking still 7.5 trillion a day. Yep. There is no matchmaking. It is generally just what people think that they think, or what their algorithms think is a good trade to take for profit for them on their time frame.
I've always wondered myself two things, which is number one, I do see, and I can't explain it, I just see it, and therefore I try and utilize it to my advantage of, let's say you see a very obvious supply zone, and price goes into that supply zone, hangs around there, gives a reaction, shows bearish, and then just does a spike up, very quick, aggressive spike up, takes out the whole supply zone just for a few points, and then actually goes bearish. And I see this time and time again, especially on the lower time frames, I see it time and time again. I can only see that as a form of liquidity grab, stop loss hunts, and so forth. But what is the reality of that?
So I think within brokers that is not happening as much anymore, which was before, we see the order book, we see everybody's stop loss, and we are just taking a run for it.
But that's more broker manipulation, not markets manipulation.
But I think that kind of era is over. So the international version of it is that there's significant bots from larger hedge funds who have this kind of capabilities to move so much funds to be able to move the market by a certain amount of pips to be able to take those runs. And they only get more
Right.
profitable the more they take out, because it's kind of self-fulfilling prophecy.
But what about, because that's what I assumed, but then I also try to think deeper and say, okay, we have a M15 supply zone, and of course there's going to be people's stop losses within that region. There's probably certain people that are putting their stop loss right above, certain people that are 3 points, 5 points. So these market makers can see where is the bulk of those stop orders, and also pending orders to trigger on a breakout and so forth. But when they do have that to run, obviously they have to move the market and therefore put in significant capital. The risk to reward of the capital they put in to the little stop losses they may gain of retail traders that are, assuming it's not internalized risk, but the orders that are there, why would they go about doing that, kind of the risk reward side of it?
So I don't think that is their target. I think the target for them is, I see a certain way of buying up this stock, this equity, or this FX pair, because when I'm starting to buy, the liquidity is going to go down, which makes it easier to buy. So they start with a certain amount, and it kind of starts to fulfill itself,
effect,
and
yes.
it starts to domino up in this example. And after that, they just take profit. And the moment they take profit, all that market volume is gone, and then then we are down at where we were.
Yeah. So when I see that, that's actually a signal for me to get in. Where if when I look into it, I actually like an elastic band where they're buying up. It becomes that domino effect of self-fulfillment. When all the stop orders are cleared and they're taking profit now, like it's just a vacuum. Who's left?
It's empty.
So then it slips down to the next bid or ask and kind of goes from there. And I'm seeing that as a stop loss hunt. Is that something you are utilizing within your strategies, whether algorithmic or manual trading?
No, we don't really do that. We are more trend following, slow, because this would be a quick result. It is to make a quick buck of a couple of $100 million on one pair in 10 minutes. So this is the real larger firms that are only able to do this kind of activities.
So when it is your algorithmic trading, the second part of my question was, this is something I see a lot. And we gave one example of a supply zone, but I see it on trend lines, I see it on support and resistances, just this quick consolidation within a zone that people would consider a valid zone, and then just a spike out and then going in the same direction. I see it day in and day out. Another thing that I see very often is these kind of sweeps happening around time. So for example, a London Open, at certain days, man, I see it on the minute. The minutes of London Open, I just see that sweep.
But
or
that's
New York
volume coming in. So that is just someone turns on their bot with a very large volume.
As you mentioned, your institution is 24/5, running around the clock.
Yeah.
Why is so the biggest of institutions, why are they restricted by time? Why are they not just running around the clock? Why does a volume come in at a London Open?
So the funny part of that is just super old-fashioned. They literally open their office. So there is a 24/5 market, but the moment that London opens is literally the moment that Citibank London opens their doors and turns on.
It's literally like that.
They have orders from the night, and they are just pressing play on all the orders that they have to work with. And at that moment, it goes in.
But it's just
market.
the old school system, because I would have imagined by now they've updated and said, okay, run it around the clock.
No, because you have a lot of risk management teams that are also have to be in their seat. So.
Okay, so it is just the manual side of it.
Yes, it's not manual, but the point is more that they have operating hours. And during those operating hours, or at the start of those operating hours, they are literally filling their orders and their books. And that's when you have high volume and high direction.
So a way that I'm individually trading is I'm looking for these two things. I'm looking for some form of sweep, just some sort of manipulation within the markets, trying to align it with trend, trying to align it with supply. But if I can see a sweep along a time, for example, a London Open is my preferred window. If I can see a supply zone getting wicked out, and I can see a London Open happening, and then I see lower time frame confirmations of rejection, let's just say for now a break of structure, this is a trio of events that I really support. But at the same time, I'm not a position trader or a swing trader. I'm just going for that London session volatility from, let's say, Asia high sweep to a supply zone, trade that 1 hour, 2 hours of London, maybe to the Asia low range, and I maybe get 15, 20 points. I risk 5 points, and I go for that 1 to 3, 1 to 5 risk reward parameter. As a hedge fund manager, is that something that is super bizarre to you?
No, so actually it sounds very similar to a strategy I was manually trading before and later choose to automate. A little bit less sophisticated, I must say, because you are adding experience. The less sophisticated version is just like, okay, we are going to open. We are looking at volatility, how big of a distance we are going to expect to certain points. And we're just going to go buy stop, sell stop, wait for a breakout, and then go one of the two directions. And that's completely automatable on every GBP pair at London opening. So these are algorithmic options where you're just taking it extremely simple, and one of the two orders will hit, makes a run for it. Trailing stops to get out of risk as quick as you can, let it run for the day or an hour, and then just close.
When I see in the movies hedge funds, obviously I'm thinking the Wolf of Wall Street vibes of, you know, a lot of high emotions, a lot of shouting, screaming, a bit of drugs, like just all that chaos. But the reality then I slap myself back to reality of that's the movies. The real life must be more calm, stoic. Maybe you have team members that are psychologists and kind of just a very comforting environment. After this conversation, I'm kind of understanding that the way you deal with emotions of traders is just cutoff points. It's just you might be feeling like you're going into a FOMO state and you really want to get into the trade, but we shut you off, so you can't do anything about it. Do you think the power of overcoming psychology is in training individuals' minds, or is just parameters and rules, and no matter what your internal state may be, if it's cut off, it's a cut off, or position size is lower because for whatever reasons, then it's lower. You can't do anything about it. Do you think that is a key that a retail trader should also look to deploy? Yeah,
so it's part of a very strong trading plan or trading strategy, right? To make sure you have rules for yourself, because the goal for us is that those rules never hit, that those moments that IT has to step in to say like, oh, we have an alert of a maximum drawdown or a maximum negative order size. We actually have to put this account as read only and close as order. That's something that you actually don't want to happen. So we are already mentally preparing for stopping yourself. You know, like if you have a 1% risk at 0.9, 0.95, you should manually choose to get out. You can wait for the 1% to hit and it goes automatically, but in generally you have that decision. That's how we mentally work with our traders, and the shouting and the happiness and the emotions, that's on the sales side, not on the dealing side.
You know, when it comes to losses within the markets, you kind of put it into two buckets. One, which is just a valid loss. It was part of the plan. It's factored in. You want it to happen. Otherwise, something's wrong. Like, this is completely the life of a trader. Then you have the other side of losses, which is invalid losses that were derived by more emotions or just random subjectivity and so forth. That pool of emotional trading and so forth, or deviating away from the plan, at times, every trader knows that I shouldn't do that. But the reality is traders end up doing that. And usually when they see that happening of, I deviated away from the plan, but it worked today. And I did it last week and it kind of worked.
Lucky.
And that's kind of like a 2 out of 10 times it was working. It just happened to be 2 times it won, and you build a confirmational bias and you start to adjust your plan. Now, I'm oversimplifying it to kind of demonstrate the question of, when do you decide to deviate away from your plan? Not in terms of emotions, in terms of, okay, I can look to improve my strategy because I'm seeing a certain shift in the data, or my recent trading, it all hit stop losses. But if I changed X parameter, it could have led to a positive outcome. How do you take a existing strategy that is favorable with an edge and data driven to looking to continually improve it over time?
Yeah, it's continually improvement, as you said. So you're backtesting, you're looking at previous results, you have weekly meetings, you're going to check how did this go, do we need to adjust something, did the market change, do we need to switch pairs or switch other securities. I think that the risk software and the actual management of the risk is a security. It's just a security when the trader does not stick to their trading plan, or when literally just human mistakes, 1 lot, 10 lots or 100 lots, it's just an extra zero. So it's more of a safety barrier that what we are doing. So we have 24/5 traders in the trading desk, and we have 24/5 IT guys on the risk desk. So it's 2 different teams that both have to just take care of client money.
Now you've reached the 10-year mark, which is I think quite an achievement. but I'm imagining you still have a long way to go and a lot of things you do want to achieve. What are those highs and heights you would like to take your firm?
Yeah, it's for me as a tech guy and also as a trader myself. I think this moment we are heavily investing in AI and database building, which costs a lot of data center resources. So basically, you start to be able to let it automatically be analyzed way more and become way more sophisticated on the trading strategy side, because programming algorithmically, a lot of people are able to do that, but we are kind of going next level there. And it's still with, I speak with a trader, he has a new idea, a new strategy, can I automate this? Can we collaborate? Okay. Can we work together? Do you want to sit behind the desk to monitor your own strategy, or do you want to teach a junior how your strategy should work? After we automated it, we can work with it.
With the tech you have access to and the team you have access to and leveraging AI, I'm curious to know how it looks like. For example, if I was to come and say, hey, look, I've got this strategy, this is how it's been performing for me, and I would like you and your firm to algorithmically develop my strategy for whatever reasons. Would I come in and say, okay, let me teach each step of my parameters, each thing that I'm looking for, and kind of that manual face-to-face interaction? Or would it be more of a case of, let me show you my last 50 trades, and through AI, it should be able to decipher the decisions? Is AI there yet where it can kind of take
Not yet. No, I think depends. If it's a very strict rule set and you have, let's say, time-based entries, so at London opening I do this, then it might be possible.
But in general, your approach is very teach the AI, not the AI give you ideas and suggest.
Yeah.
So it's heavily interacting with the
AI is just going to ignore your previous trades and starts to build its own.
Okay.
Yeah. So the point of AI trading is something that is not very operational in many firms. It's just it becomes this black box where in a month you have original parameters, you give it direction, but in a month you might still understand why it opened this trade, and in a year from now you don't know anymore why it opened that trade, because it is going so far away and optimizes itself towards your original strategy. So you start as simple as possible. You start with trend lines, you start with Fibonacci, you start with certain things, but it might adjust Fibonacci thinking it's better than Fibonacci, so yeah,
I understand.
It's hard to imagine, but that's where AI can bring it. So it becomes this black box of a trader that you just don't understand. Well, I feel the success in our firm is we speak to those traders. Everybody has a 3 or 4 year track record when they come to us. Real account, own money, we validate that. After that, we trade about a year together on maybe a 100K account or something like that. No client money involved. When we understand what you're doing, can be any random strategy, but we want to understand what you're doing, because otherwise the mental coaching doesn't work. So we need to understand what your thoughts are, what your strategy is, if it's possible to automate or not. And then we start to work together, and then slowly client money comes in, more client money comes in, you get adjusted to the mental side of it, and then you can be a long-term trader within the firm.
I'm curious to hear your perception of the current prop firms, the simulation challenge model approach, where if somebody's coming into your hedge fund as a serious trader that has a track record and true competence, obviously they're trading investors' money. So I'm sure your firm has a performance metric, but the majority of the profit goes towards the client, and rightly so.
Sure.
So you have a management and performance side, and then that's got to be split after your costs of your team, developers, and so forth. Meaning to say, if an individual trader is trading a $500,000 account within your organization, and their profit split as an individual is a minor percentage of it, why does somebody choose to take that professional route and work in an institution, as opposed to just taking that skill set and deploying it into prop firms and going for $2-3 million in simulated funds, but in the end they do get a 90% split and maybe monetarily be able to gain more? I'm curious to hear, because a lot of the viewers are watching are prop firm traders and completely indexing their career for that, maybe not considering the longevity side and so forth. So I want to kind of hear your thoughts between prop firm trading like an FTMO versus hedge fund trading, and kind of trying to get a job and take it as a career.
Yeah, so I think you answered at the end there, because that's the difference. It is a job, but it's a career. It might come with a base salary. It might come with a desk, with even a work from home desk, but it still comes with the colleagues. It comes with the responsibilities, and it comes with potentially more AUM, assets under management, than that you can max out on the prop firm side. So I think the prop firms and the people who are doing well there, managing maybe one or multiple millions, they have kind of almost the same. You're managing professional funds, simulated or not, but you're basically being able to make money with money.
Yes.
And in the hedge fund business, it just can become bigger accounts, bigger than maybe the maximum of the prop firms. But it's also a career. It involves colleagues, maybe a Christmas party here and there. And that's things that people don't have when you trade at home alone for a prop firm. So I think that people come for us also for the social aspect, the coaching, and just having it as a job.
I'd also maybe like to say that there's also a sense of reality, because in prop firms, just like you said, the black box of AI where it just thinks it's better than Fibonacci and goes down its own rabbit hole. I think it's very easy for a prop trader to start off with good intentions and then start to realize, well, if I blow the account, it's $500 to buy a new one. So you have a reset button, which in a hedge fund in real life, you don't have that. And then you just start to notice the little tricks. You can kind of gamify the situation, or say buy on this prop firm and sell on this one because I'm not sure. And maybe on this one where I win, I make 10K, but in this one I lose the 500 fee. So you can really gamify the situation and end up not being a real profitable trader. You're just play money and so forth. Would you be interested in someone that has displayed, let's say in the last year, a $200,000 payout across various firms and so forth, but no individual track record? Would that individual trader be any of interest to you?
No, because that does not show us his strategy. It does not show that the strategy works, his mentality. Basically, we would like to see one account, which I know is very hard to get. So sometimes it might be two accounts as in a good reason of switching broker or something like that. But in general, we are looking for traders 4 years, one account, and then just send me your verified account, and we are gonna double check order sizes, open sizes, risk, drawdown, very basic things at the beginning, and I can very quickly say if that qualifies or not for also what our clients are looking for.
I want to wrap up with a question around data and something that you've been working with within your own firm, and you mentioned how information is important and so forth. Now I see a $1 billion problem to be solved, which is there is so much activity and retail traders' decision making involved with the prop space now. I think there's been a switch in the last few years from retail traders going to brokerages to just leveraging prop firm capital. So certain prop firms probably have hundreds of thousands of users and daily millions of trades per day that are happening. That is so much data and information. But from what I understand, no prop firm is really using that data to make money, or kind of putting parameters to find their anomaly traders, and they're just booking, internalizing, going on the challenge fees, payout ratio. Do you think there is a way, or in the future, somebody could come in and kind of crack and say, okay, these are 100,000 traders data. How can I kind of read between the lines and make a hedge fund out of that and leverage not just one or two, or in your case, dozens of traders, rather a sample size of hundreds of thousands of traders, and clean the data to find profitability? Do you think that's doable?
I know there's prop firms who do that. They do try to find their top 5% or top 1%. Like the statistics are 1 in 800 accounts are profitable. So you have to find that needle in a haystack.
Yes.
The issue is the moment you find it and you choose to A-book, he might blow up because he only thinks it's a $500 loss. And then you go down with your A-book as a prop firm. So there's prop firms who kind of take the no risk idea of like, we're just going to make more on subscriptions. The other ones are trying to find the profitable traders, but then you see they mostly start to build a relationship with them. They say like, come to our office, let's meet. We do, I don't know, a resort event for our top traders, or everybody who reaches $1 million or more is going to get some form of VIP treatment, which is try to get to know you if you can actually be used. And then they probably trade a way larger size than that you see.
On the back end.
Yeah.
Yes,
so they
yes.
would just say, I expect this trader to be profitable. Let's do that times 5. And then they make more than enough to pay out the others.
I've spoken to a bunch of founders of prop firms, and they said, unlike brokerages where you can kind of use the data and A-book individual clients, in prop firms you can't, for that reason you mentioned of they might just wake up and change their mind because it's not their money and you can't see that happening. There's no data, there's nothing for that. Maybe the only thing you can do is parameters of ordinary behavior, and then if they start to trade an Asia session but they always trade London and they double their size for no reason, then you kind of ignore that trade. And maybe there's approaches to clean data, but I do know a lot of firms are looking into it, but I do see that as a cool problem to be solved.
There's another very good idea is to just take all the losing traders, which is 799 out of 800, and trade the opposite.
I asked one of the founders, and he said with demo environments versus live executions, just a bit of latency and this kind of things. He said it sounds good, but
it's very difficult.
Yes,
I
exactly.
know
So
on the long run, I know one trader who took like 15 years of data from one brokerage firm and traded their whole book in the opposite direction.
Okay.
And that was a profitable strategy,
Makes
even
sense.
though there is slippage and there's all kinds of other factors that a profitable trade might not be profitable due to cost. But on the long run, not an extreme amount, but there was still a positive net result.
I'm sure in the coming years and decades there will be a kind of new age of hedge fund which is going to be leveraging, as you are, and I wanted to say it's not the conversation I expected, because you are going for individual retail traders seeing their competence and building around that, as opposed to what I would imagine a hedge fund is. But I think a layer above that is just utilizing the data of brokerages, prop firms, and so forth. I just want to end the episode with an opportunity for you to just give final advices. The audience is usually individual retail traders, up and coming, maybe seeking profitability. If there's any words you can give them as a hedge fund manager.
I can only say keep going, because it is a job at the end. I've seen people quit their jobs, trade full time, and then go back to their jobs because they realized it's a job. So I think it's very good to take it professional, trade for a longer time. The longer you trade, the more options you're gonna have in a financial market that maybe starts with friends, family, or broker platforms with copy trading, MAM, PAM, and other things. You probably can get a $500,000 to $1 million under management, real money. Those things really can boost your career, because if you do that, and with that track record, you come to any hedge fund manager, say, I manage 500K PAM trading at a certain broker for a certain time, you're already used to client money even. So keep building a track record as clean as possible, preferably one account, one brokerage that you trust, and as long as you can to show what your competences are.
Brilliant. Bas, thank you very much for joining.
Thank you so much for having me.
There we go.